We have portfolio now about a little over 80 million feet.
Wow.
Of that, we own about 17, about 18,000 employees and 5,000 trucks, 14,000 trailers, and a non-asset business as well. So service everything from goods manufactured from the ports in Asia all the way to delivered to your house. Primarily, we're in the US and Canada in terms of our footprint. And just a super dynamic place to be.
Welcome to IAMC conference. We have our Industrial Advisors podcast. We're live here in Little Rock, myself and Matt. And we have Michael Landsburg, who's at NFI, joining us this morning. So great to have you, and thanks for being here.
Industry legend.
I don't know about that, but thrilled to be here this morning, bright and early.
Thanks for joining us.
That's right. So why don't you tell us a little bit about NFI and how business is going and kind of your approach to the 3PL world?
Sure. So NFI, we're the largest privately held, family-owned supply chain company, third-party logistics company, owned by the same family for, we're in our 94th year. And started in 1932. It's now in the third generation of ownership. Three brothers control the company today. And they have each have three kids, and some of that generation is coming in. So moving into what we like to call G4.
They survived the third generation.
They did. Yeah, it's really impressive. And I've been there for just about 21 years. Unfortunately, it's not my family, but I've been there a long time.
Kind of now.
They treat me like family, so that's good and great place to be. Super dynamic, fascinating to be. And my background's in finance and real estate, and fascinating to be kind of behind the scenes in a supply chain company, seeing how goods move and why real estate and industrial and logistics decisions are made in this location or that location. We have portfolio now about a little over 80 million feet.
Wow.
Of that, we own about 17. About 18,000 employees and 5,000 trucks, 14,000 trailers, and a non-asset business as well. So service everything from goods manufactured from the ports in Asia all the way to delivered to your house. Primarily, we're in the US and Canada in terms of our footprint. And just a super dynamic place to be. And obviously, since the pandemic, we were growing pretty quickly before that, but supercharged growth, since the pandemic. If you didn't know what logistics was before the pandemic, you certainly knew what it was afterwards.
That's right. So 80 million feet, and you mentioned you guys own 17 million of that, which is unique. So talk to us about when you look at owning an asset versus leasing an asset and how you guys make those decisions.
Sure, yeah, and I'll throw a third variable in, which is we also operate buildings on behalf of customers. So
that's outside of the 80 million.
It's included in the we included in the 80 because it's really, we have influence into those decisions.
Yes.
And it's all our people in those buildings. And so I'll start there. So that's where on the leasing side, sometimes the customer wants to hold the lease, for accounting reasons or other reasons, and sometimes they want us to hold the lease, and we're fine either way. And so that's on the leasing side, a decision that gets made early in the process. Sometimes it's a dynamic in 3PLs. Sometimes that happens later in the process, which can be a challenge where, we've gone down the road and sourced real estate, and then a customer comes in at the end and says, well, we also went down the road, we leased this building over here, we still want you guys to operate it, don't worry about your real estate. So sometimes that happens.
Yeah.
Or sometimes they take on the real estate that we source. But in terms of the ownership side, 65 years ago, grandfather started the business, passed away at a relatively young age. The father started to build it up, and the three sons who own it and run it today started coming in the late 80s. And the father, when he was running it, he saw our expansion we started in New Jersey, still headquartered in New Jersey, in Camden, right over the river from Philadelphia. And when he started to expand out of New Jersey, decided that, hey, there's an opportunity to own some real estate here. The country is expanding, and started to own some real estate. We like that control sometimes.
Sure.
And so in markets, we don't want to own in every market. And sometimes the speed of the transaction doesn't allow us to own. So those are some decisions that get made. And then we also own just as an investment for the family. It's a way to diversify their portfolio to own some real estate. So of that 17, we only occupy and lease about a third, our sister companies. It varies between 30 and 40%, depending on transactions. But so that's a tool for the business to grow connectivity to customers, diversify family investment, and really exciting to be able to be on that side of the house as well.
On the percentage of ownership, what's the goal? Where would you like to be if you own 17 million feet? Like, when did that growth happen, and what would you like it to be?
Good question. So I started in '05, and at that point, we owned about 4.5 million feet. Portfolio was much smaller.
So mostly under your watch.
A lot of it, and I mean, I've been there a long time.
Yeah.
That's what happens. It's not all because of me. Great team.
We give you all the credit.
And some of it is just the market, frankly, and the family, willingness to invest. So that was portfolios owned of about 4.5 million feet and total size of just under 20. So similar ratio at that point. And so both have kind of grown over that time. But what happened in '08, when I started, in '05, we were in most of that space ourselves, leasing it to ourselves, right? 70% was leased to ourselves. And then the global financial crisis happened, and we said, hey, we love ourselves as a tenant, right? Yep. Great tenant.
For sure.
But this is a good way to diversify. And so we set out on a plan to really diversify to lease to third parties because it creates another opportunity for flexible solutions for customers, right? Sometimes they want to lease the building themselves and we say, hey, we can be your landlord and lease it to you. Or sometimes we get opportunities on the supply chain side that turn into real estate transactions. And sometimes we get opportunities on the real estate side that turn into supply chain transactions. So it's a great tool in our toolbox to be able to service our customers and their solutions. And so coming out of the global financial crisis, that started to grow. We flipped that 180 degrees. So we were in most of the portfolio, 75%. And then fast forward 10 years to 2018, we had almost tripled the portfolio. And then since we've had growth in the last 7 years, 8 years since then, but really grew the portfolio and started leasing to others. And so that's where that dynamic really started to change.
Yeah, that's been probably a really good return for you guys, an investment, given how great industrial real estate's.
Some of it was just the market. We like to say it's better to be lucky than good sometimes, and
you guys
some of it was just being in the right place at the right time.
So you guys operate a lot, across the U.S. and Canada. The market softened some on the industrial side over the last, 24 months or so. Have you guys, when you're just looking at leasing specifically, tried to take advantage of the fact that the market softened a little bit and done anything differently on your leases?
So I would say what's been fascinating, and you guys, I'm sure, have seen it in the Pacific Northwest. What's been fascinating is, yes, there has been softness in the market for sure, but it really, more than any time over my career, and I worked at another smaller real estate company for about 4 or 5 years before NFI, it's really been kind of submarket to submarket, building by building, where other than in certain pockets, maybe Southern California as one over the last, 30 months, where it's been more broad-based, it depends on your need. Right. So you could need 200,000 square feet in a market and there's 2 buildings and there isn't softness in that market. Yeah. Or you could need 500,000 feet in a market and there are 10 options, and so you can kind of write whatever deal that you want. So that dynamic of it's really a building by building circumstance has been, just fascinating to see over the last 2 years. I will say this year, starting from the beginning of the year, you're starting to see that turn a little bit, unfortunately, for the tenant side. Right. But in answer to the question of did we do anything different, not really. I mean, what's been different for us, it's been good business for us the last couple years, but we had 22 was our best year ever. Mm-hmm. 23, we were down about 12% or so.
Way less than industry.
Way less than industry.
Yeah.
We were really proud of kind of holding firm, and then we've been kind of flat, up a couple points since then. So we've been really proud of that kind of staying, but that's resulted from a lot of churn, new customers, and loss of some business. And so we've been relatively flat from a transactional stuff. A lot of transactions, but in terms of net absorption for ourselves, it's been relatively flat. And so the challenge has been some of the decisions just have taken much longer to make for companies, understandably so, with tariffs and geopolitical uncertainty and so forth. So we've really just stayed the course. It's not like we've said, hey, the market's soft, let's do 10-year leases. We've tried to stay consistent, and we've taken a little bit less risk than we have in prior years. Maybe that's a difference, where previously maybe we would say, hey, customer wants a 3-year contract, let's go sign up for 5, or they want 200,000 feet, let's go sign up for 400,000 feet. We've reduced taking some of those risks and trying to match up leases with contracts more in these last couple of years than we have previously.
Yeah, and that's definitely consistent across the board with what we're seeing in the 3PL space, for sure.
Talk to us a little bit, if you can, without letting your competitive advantage out to the market. Talk to us about technology and maybe AI, what you guys are doing. I know that's a little bit outside of real estate, but what are you guys doing, if anything, in those spaces to give yourself an advantage?
We have to mention AI, so then we'll get that. You got that many more hits.
That's right, of course.
I love it.
We just got like 10,000 more likes.
Right. We're just going to embed
AI.
Right. Exactly.
Exactly.
So we have really started managing our data differently a number of years ago, and so that's when people talk about AI, you have to have the source data to be able to utilize it. And so we started that process years ago, or refine improve just the management and centralization of all the data. As you can imagine, we have fantastic data across all the business units, transportation, warehousing, logistics, et cetera. And so that was our first step. And now, being able to utilize that and leverage it in a way that makes everyone move faster, more efficient, and be able to just accentuate and make what folks are doing before using tools that much better and faster after they're using tools. So that's, generally on the data side. And then in the buildings, just not necessarily AI, but the technology and the opportunities with automation and just managing our customers' business is fascinating and incredible. We have operations with fully autonomous robots in them, and
Fully
autonomous.
Wow.
They're going out and picking product and coming back. They charge themselves. I mean, it's
to think like when you got in the business in like 2005, like if you would have thought 20 years later there'd be robots running warehouses.
Incredible. So that kind of stuff is super cool to see, and those are great tours to give. And all of it is it's to make our, the team more efficient again and be able to service customers faster, better. And so those are some of the things that we're doing.
And then that last question, from me at least, Chinese 3PLs, we saw a huge growth with them. I think like 50% of the deals in the Inland Empire over the last several years have been the Chinese 3PLs, or I should say Asian 3PLs. How has that affected you guys? Do you partner with them? Is that just competition? And where did that come from?
Great question. And I was going to mention something like this in the, what has been different over the last 2 years question. So I think we're still figuring it out, I'll say. They are, some of them are very good operators. Some of them are new entrants to the market. On our own portfolio, we have a couple tenants that are Asian-based 3PLs. And it started as a way, we think, to get rid of some of the middle fulfillment, whether it was in Asia or coming over here. And so, one of the things, and I'm going to ask a question back, is it's not entirely clear to us if this is taking market share from us or if it's new business to the market. In other words, are these manufacturers in Asia coming in with their own supply chain fulfillment providers, and they would have used us in years past, but they're just using themselves? So it's taking market share from us, but it's still new product, new space, new absorption in the market, versus this is product that we would have fulfilled previously, and now it's being fulfilled by someone else. And so it's not net new product to the market. It's just we are not leasing the space, they are leasing the space. And so it's a actual reduction in absorption in the market. So I don't know if you guys see, hey, is this product like product that would have been a big retailer's product that maybe a domestic-based 3PL would have handled 3 years ago that now is being outsourced to Asian. And so it's the same footprint. It's just being handled by someone
It's a great
different
question.
versus it's true new product to the market.
Yeah. In our case, this is a great question, obviously, for the Steve Bellettis and the Inland Empire guys, because that's where it's happening.
Yeah, we see it in Jersey,
Yeah.
the Inland Empire, Savannah.
Yeah.
It's been busy, and in Texas they've started to pick up.
We've seen, I believe, 2 deals, and both of them were brand new. So it wasn't like pull it out of somebody like NFI and suddenly it's operated by an Asian 3PL. So it was new to the market and specific use. But to answer the question, I think it's both. It's new to the market, but a few years ago it would have gone to a company like
Someone
NFI
does.
for sure.
Yeah, and I think that as some of those, you mentioned some of those companies are new, as some of those firms get more established, maybe then they start trying to take market share from existing 3PL companies.
Yeah,
After they get more established.
yeah.
Yeah. Well, we have a full day ahead of us here.
Full day.
So
Always good time at the IAMC
yeah,
conference.
great way to
That's
kick it off with you. So appreciate you joining us and sharing
Sure.
some insights on NFI, and have a great rest of your day here.
Thanks
Thanks
for
so
having
much.
me,
I
guys.
appreciate
Always
it.
good to see you. Appreciate it.
Appreciate it.